So, what happens when the most reliable signal in all of crypto just stops working? For years, you see, the Bitcoin halving was this predictable 4-year drumbeat that basically guaranteed a massive market rally. But this year, in 2024, the rhythm broke, which leads us to the big question: is the legendary Bitcoin halving cycle finally over?
I mean, think about it. The Bitcoin halving wasn't just some random event. It was the metronome for the entire market. Traders, investors, you name it. Everyone set their calendars by it. It was the starting gun for the bull run. And for a solid decade, it never, ever missed.
And when you look back at the history, the data is just wild. The first halving, way back in 2012, Bitcoin shot up from about $12 to over $1,000 in a year. Then in 2016, the second one lit the fuse for a run to nearly $20,000. And of course, the third one in 2020, that kicked off the massive surge to almost $69,000. Every single time, the pattern was the same: halving, then rally, like clockwork.
But then came April 2024. The fourth halving arrived, and the rocket just never launched. The whole market kind of held its breath, waiting, but that explosive rally we all expected, it never happened. So the question we all have to ask is, what broke the pattern?
Okay, so to understand why the pattern broke, we first have to go back to basics. We need to look at the source code itself. It all comes down to a concept that's as old as money itself: scarcity. The Bitcoin halving is an event that's literally hardwired into its code. About every 4 years, the reward that miners, the computers that secure the network, get for their work gets sliced in half. This means the pace at which new Bitcoins are created slows way down. It's a pretty brilliant way to control inflation and make sure there will ever be 21 million Bitcoins, period.
And this is why you always hear people call Bitcoin digital gold, right? Gold is valuable because it's rare. You can't just print more of it. Well, Bitcoin pulls off the exact same thing, but it does it with code. It creates this new kind of scarcity, program scarcity. And that's the economic engine that's always been behind the halving cycle.
And the historical impact of this program scarcity? Well, the numbers really do speak for themselves.
I mean, just look at these numbers. Before the 2012 halving, Bitcoin was about $10. A year later, over $1,000. Before the 2020 halving, it was sitting under $7,000. A year after that, over $55,000. The formula was so simple. Less new supply hitting the market plus steady demand equals a massive price explosion. It was a cycle you could practically set your watch to.
And this rally wasn't just about Bitcoin either. It created this predictable wave of cash that would wash over the entire crypto market. Money would pour into Bitcoin first. Once it peaked, those profits would start rotating into Ethereum, then into other big projects, and then finally trickle all the way down to the smallest tokens. It created this market-wide altcoin season, a classic repeating cascade of money.
But in 2024, the music stopped. That predictable past was just shattered, and the market found itself in a totally new and, frankly, uncertain era. After the halving this past April, the old script was just completely torn up. There was no parabolic surge in Bitcoin, no cascade of capital into altcoins. The market just stalled. The engine that had so reliably powered every single bull run before seemed to have just run out of gas. So, what changed, right? Why did this fourth halving fail to launch the market into orbit like all the others? Well, the answer isn't just one thing. It's actually a combination of powerful new forces at play.
It really boils down to 3 major disruptions that completely changed the market's DNA. A huge flood of institutional money, the new dominance of macroeconomics, and, well, simple dilution of the market. Let's break each of those down.
First up, the institutions. The approval of spot Bitcoin ETFs in the US was an absolute seismic shift. For the very first time, massive financial players, we're talking pension funds, hedge funds, could easily buy Bitcoin. Billions of dollars poured in before the halving even happened, creating this tidal wave of demand that totally front-ran the supply shock. This wasn't retail FOMO. This was calculated institutional scale buying. The game had changed.
Second, crypto isn't on its own little island anymore. It is now deeply connected to the global financial system. Things like Federal Reserve interest rate decisions and global liquidity, they now have a way bigger impact on crypto prices than the halving does. These days, the market listens more to Jerome Powell than it does to Satoshi Nakamoto's code. And finally, dilution. Look, in the early days, money didn't have that many places to go in crypto. Today,
There are tens of thousands of different coins all competing for attention and for your investment. That same pool of speculative cash is now spread incredibly thin, which makes that classic market-wide altcoin season so much harder to kickstart.
So, with the old map being pretty much useless, where does the market go from here? Right now, there are two main theories competing to explain this new reality we're in.
Okay, so on one side, you have the delayed rotation theory. These folks say the old cycle isn't dead, it's just late to the party. Once Bitcoin finally peaks, that money will eventually flow into other projects, just way later than we're used to. But on the other side, you've got the new reality theory. This camp says the cycle is permanently broken. Institutional money and macro trends are in charge now, and only a select few projects with real fundamental strength will actually do well.
When you look at all the evidence, it really suggests the cycle isn't completely dead, but it has definitely evolved into something profoundly different, something more mature.
And this really gets to the core of the change. Bitcoin now behaves a lot more like a high-beta tech stock, like a riskier version of something you'd find on the NASDAQ. It rallies when the broader market is feeling good, and it falls when the market gets scared. Its connection to traditional finance is a brand new and probably permanent feature.
So what are the key takeaways for this new era? First, the halving is now more of a background story that reinforces scarcity. It's not the main event driving the price anymore. Second, macro trends are the new boss. You gotta watch the Fed, not just the block count. Third, yeah, we'll still see crashes, but with all these big institutions in the mix, they might not be as brutal as the 80 or 90% crashes of the past. And most importantly, the old, simple rules, they're gone for good.
The 4-year cycle that defined Bitcoin for more than a decade has clearly evolved. It's not a solo act anymore. It's tied to the global economy. So the real question we're all left with is this. As this market continues to mature, what new rules is it going to follow?